Morning, dear students. How are you all? I welcome you to this amazing session of ICAI, wherein we'll be revising the CA final advanced financial management topics of mutual funds and business valuation in today's session. So it's going to be like the power pack session today because we'll be covering a lot of concepts and maybe a few practical problems also we'll be discussing from the previous assignment which I have shared since when these topics were dealt in detail. Okay, so now we have already covered this topic in detail. Both the topics were covered in detail when we were discussing the subject in the previous sessions. So right now in today's session, we'll be sort of revising the things and also taking up certain queries which you guys might be having from these topics. Okay, so let me first revise the concepts, then maybe take up a couple of questions, which may be sort of some sort of questions which would cover almost all the concepts because due to time constraint, we may not be able to discuss everything at large, right? So let's simply get started with the mutual funds concept first up. Well, we know what's a mutual fund. Mutual fund is basically a commingled sort of fund where the money is collected from different investors from the public and a combined fund is created. Okay, so let's say we have a sponsor over here, let's say naming it as SBI Limited with 10 crores of capital. So we have a sponsor, SBI Limited, with 10 crores of capital. And then we've got like it wants to open up, let's say, SBI Mutual Fund, right? And remember, this mutual fund is established always as a trust in India. Okay, so this sponsor with 10 crores of capital establishes a mutual fund trust, and it comes out with NFO, or what we can say as new fund offer, right? So this new fund offer, NFO, is going to be offered to the public, asking for 990 crores. Okay, so the individual members from the public gave 990 crores to the mutual fund trust. So now the total money which the mutual fund trust is having is this 990 plus 10 crores, that's 1000 crores. So that 1000 crores, so the 1000 crores is going to be invested into the securities, and that investment is going to be made by way of a asset management company. Okay, so this asset management company will be the one who's going to handle this 1000 crores, right? So asset management company is the one that's going to handle the 1000 crores value. Now SBI Mutual Funds Private Limited, let's say that's a AMC, right? Additional Mutual Funds Management Private Limited. That's the AMC which is formed, which is going to manage this 1000 crores. So this AMC is going to have its own fund manager, its own staff, its own setup to deal with the securities, to buy or sell the securities, to identify the securities, wherein you can simply say that there's a identification of securities, entering into contracts. So all those things are undertaken by the asset management company. Apart from this asset management company, we are also going to have the other parties, which is like the distributor. So these are the persons who are going to distribute the mutual fund to the public at large. Right? So this is going to be the set of institutions or individuals who are going to distribute units to the individuals and to the public at large, where money will be collected, and of course that will be transferred to the trust. So somewhere the distributor stands in between this. The mutual fund, so the distributor stands between the mutual fund trust and the public. Then we'll have someone who is going to be a registrar and transfer agent, who's going to handle the transactions of transferring of securities, or purchase and sale of securities, or settling of trades, collection of the money, and payment of the transactions that have been made. So that's a registrar and transfer agent. And once the securities have been purchased, of course, the mutual fund itself cannot hold the securities, because then there's no concept of maker and checker. And so we need to have that maker and checker concept. So we need to have a third party who's going to possess or who's going to hold the securities, and who's going to give us a sort of validation or verification that there's some sort of validation verification that the securities are held correctly, right? So that's your custodian, which is possessor of the securities. And mind you that this custodian is going to be a banker, which is going to be separate or other than the SBI. Okay, it's going to be other than SBI. So you'll have a custodian who is a possessor of securities. It's like HDFC Bank and the Citibank. Okay, so this is the broad structure we have for the mutual funds. Now, of course, there are various types of mutual funds. Let's simply try to understand how the mutual funds are going to be classified, or rather, before we go for the classification of mutual fund, let me just put in front of you how the mutual fund functions, or let me just go into the classification of mutual fund itself. Okay. So classification of mutual funds, we can have it like based on functional classification. Now, when we say functional classification, it could be a open-ended, closed-ended, or interval funds. When we say open-ended, these open-ended mutual funds are simply the ones who are, open-ended mutual funds are simply the ones who are open for issue of new securities and redemption of securities throughout its life. So it's like it's never ending, right? It's like if you want to buy some additional units from the mutual fund, you can definitely go to the mutual fund, ask for the units. If you want to sell your mutual fund units, you can definitely go back to the mutual fund and give the units back to the mutual fund. There's no issue at all. So there's no restriction with regards to purchase and sale of units directly from the mutual funds, because the mutual funds are open to the transactions throughout the tenure. Then you have another type of mutual fund, which is a closed-ended mutual fund. And when we say closed-ended mutual fund, we're talking of those mutual funds which is having that feature of being closed. It means once you have put the money, once you have given the money and taken the units from the mutual fund is not going to redeem it unless and until it is going to terminate its entire mutual fund business. Right? So that particular scheme, unless it is wound up, it's not going to be redeemed. Then how are we going to get the money for our securities, sir? You can definitely get the money for your securities by selling it in the stock exchange, because it is mandatory for this closed-ended mutual funds. Okay, it's mandatory for this closed-ended mutual fund to get themselves listed on the stock exchange. Okay, it's mandatory for the closed-ended mutual fund to get themselves listed on the stock exchange. And then you have something called as interval funds. Interval funds. So interval funds are like they remain closed for certain tenure and then they open up for certain tenure. Right? For certain years, they remain closed, which means they're not going to accept any redemption, neither they are going to issue any units. But then for certain other period of time, there's going to be opening up. Right? They are going to be accepting fresh redemption requests as well as fresh units issued. Right? So these are like based on classification on the basis of functionality. We say it's open-ended, closed-ended, or interval funds. Apart from that, you have like portfolio-based classification, which would be equity funds, debt funds, or special funds. Even in equity funds, if you have the mutual fund which is more focused towards the growth. So if it is more focused towards growth stocks, it means the stocks which are going to provide high growth in future. That's called as a growth fund. Aggressive funds, which are taking aggressive strategy or investing into some risky securities. That's what aggressive funds. Income funds means those funds which are going to invest in securities which provide a good degree of dividends. Then we have debt funds, which are basically investing into the bonds or investing into the government securities. There can be some special funds which are targeting for a typical index, international companies, or some offshore investments, sector funds, or investing into only the money market securities, gold, commodities, or quant funds. Which is quant funds is basically those funds which are investing in securities based on the quantitative analysis. Then we have something called as fund of funds. So fund of funds is basically a mutual fund invests into multiple different mutual funds, so giving you like greater degree of diversification benefit. Certain funds we can have something called as a capital protection fund. Now let me just explain you what's this capital protection fund. So let's say investment of 1 lakh is made, which is the capital that you're making. Now we want to be sure that by the end of 3 years or beyond 3 years, we want the capital to be protected. I mean, the value of our investment should not fall below 1 lakh. Right? So we want the capital to be protected. So investment is going to be 1 lakh, which is the capital. So investment horizon is, let's say, 3 years. Now the best way to do this is, we want our capital to be protected. So let's just take the present value at risk-free rate. Okay, so 1 lakh with the investment horizon of 3 years, risk-free rate is 7.5%. Present value of capital at risk-free rate is 80,496. Okay. Now this 80,496, which is the present value at a risk-free rate of return, that's going to be invested in risk-free securities. Right? That's going to be invested in risk-free securities. And then you have like 80,496 and 1 lakh. The difference, 19,504 shares. These are going to be, right? This is going to be invested into the shares or in the risky securities. Now, after 3 years, this risk-free securities, 80,496, this risk-free securities is definitely going to be maturing to 1 lakh, which is a sure and a certain number. So we can definitely say that the 1 lakh capital is protected. And whatever change is going to happen in the shares, that's going to happen as it is. So we can say 19,504. 19,404. Let's say the value of the shares turns out to be 30,000. So total redemption can be made as 1,30,000. Now it's quite obvious that the value of shares, which is turning out to be 30,000, even if it's worthless, even if you have invested in certain securities which are worthless, still you'll be able to redeem a value higher than the investment which you have made. So it's basically like the money that you have invested, the capital that you have invested, that's going to be staying protected. Okay. Then there can be balanced fund where they are going to invest in both equity and debt. We can have diversified equity schemes, which could be like large cap, mid cap, small cap, right? Investing into these typical funds, right? Now, there are certain advantages, disadvantages of the mutual fund that we can think of. So why would you like to invest in a mutual fund? So first off, you'll have the exposure to the professional management, because mutual fund is going to be managed by a fund manager, and that fund manager is definitely going to be the one who has got knowledge, who is qualified, and who's also some sort of having an experience. So you'll have professional management, diversification benefits you get, because with limited capital you can invest in multiple securities through mutual fund. Convenient administration, you get a higher return at a lower risk. Lower management cost, which is maximum 2.5% in case of equity. You get a liquidity, you can liquidate any of those units quickly. You get a transparency, because the mutual fund are supposed to be giving you disclosure about where they have invested, in what proportion the money has been invested, and also economies of scale. Then, similarly, it also suffers from sort of disadvantage. So first one is there's no guaranteed returns, right? So disadvantage is like the mutual funds are having no guaranteed return, low return due to diversification. Selection of improper scheme could also be a cost for us, and also there could be certain cost factor which is involved. So you can have like entry load. When you are entering into a mutual fund, you need to you may be required to pay some sort of fees. That's called as an entry load. You may be taking when you're going to move out of mutual fund. That's called an exit load. Then you may have some amount of management fees also getting involved. Okay, so these are the disadvantages that we have for the mutual fund. Okay, now with this sort of thing, let me just take up some question from the previous handout, right? And that will be like good for us to recap certain aspects. This is the same assignment which I have shared, so I'm just going to revise few questions from here. Okay, so I'll just do this on a pen paper mode today. Okay. Okay, so let us take up uh, let's take up this question. Let me just copy it in our sheet also. Okay. So on 1st April 2009, Fair Return Mutual Fund has the following assets and prices at 4 p.m. So let's say this mutual fund is having these 5 securities, right, with the number of securities and also market price being mentioned. We want to calculate the NAV of the fund as on 1st April 2009. Assuming that on 1st April 2009, HNI sent a check of 50 lakh to the fund, and fund manager immediately purchases 18,000 shares of C Limited, and the balance is going to be held in bank. Then what will be the position of the fund? Now, suppose on 2nd April 2009 at 4 p.m., the market price of share is as follows. A, B, C, D, E. You have got the new prices as on that date. Then we have to compute what will be the new NAV. Okay. So we have to first get the NAV of the mutual fund. Right. So first thing is we're going to say calculation NAV of mutual fund. So we have these shares, the market price, right? So we can compute the NAV by simply writing down the value of shares, number of shares, then we have market price per share. So what are we supposed to do is we'll just write down the name of the shares as A, B, C, D, E. Number of shares is 10,000, 50,000, 10,000. Right, then 1 lakh and 30,000. Now, market price per share is 19.7, 482.6. 264.4, 674.9, 25.9. Okay, so these are the market price given to us. Now, how do we get the NAV of the fund? Because we don't have any cash as such in this particular mutual fund. So, of course, when we are computing NAV, it is going to be sum of all the values divided by number of units. So, sum of all the values is basically number of shares multiplied by market price per share, right? You take a total, right? And then divided by the number of units. Number of units is given to us. Number of units is 8 lakh. Right, guys? Okay. So now just tell me, just calculate these numbers and give me this total number, guys. Multiply each one of them and give me the total value. Come on, let's do it. Give me the total. Give me the total value so that we can compute the NAV. Yep. Multiply and give me the total, guys.
952.
The final value?
Total value is 952, 38,
Uh-huh.
20.
20.
3 zeros.
After 38, there are 3 zeros.
Yes.
Okay, so that's like what? 9 crore 52 lakh 38,000. So NAV is 9 crore 52 lakh 38,000 divided by 8 lakh units. Right. So that works out to be
119.0475.
119.047. Right. That's a mutual fund. Yeah, that's a NAV of the mutual fund. Now, the second thing that we have to look at is from this question, assuming that an HNI is sending check to us of 50 lakh and let's say the check is encashed immediately, we are going to purchase, let's say, 18,000 shares of C Limited and the balance is going to be held in bank. So part B of the question. Part B of the question. HNI send a check of 50 lakh. So with that 50 lakh, we have purchased 18,000 shares. Now, of course, 18,000 shares of C, at what price we would have purchased the C? Of course, at the prevailing price, which is 264.4, right? So 264.4. So in part B, we will say money spent or money invested in new shares of money invested in the new shares of limited.
47,59,200.
There will be 18,000 shares into 264.4. 264.4. Yeah, how much is this? 47 lakh
59,200.
59,200, right? That's the money invested in the new shares of C Limited. Okay, what was the balance left? Balance money left in cash?
2,40,800.
Balance money in bank will be 50 lakh minus 47 lakh 59,200. So that's 2 lakh 41,800, right?
40,000.
2 lakh 40,000. Yeah. 2 lakh 40,800. So this is the balance money which is left in the bank. Now, after this, we have to again redraft this entire part, right? So we'll say shares, number of shares, then we have got the revised market price, and then we will get the value. So we have like shares A, B, C, D, E. Number of shares are 10,000, 50,000. Right, so first two shares are definitely going to be remaining same.
Only changes in C.
Only changes in C. Yes, 10,000, 50,000. C, it's going to be like 10 plus 18, so 28,000, right?
Yes.
And D is 1 lakh and E is also 30,000. 1 lakh and 30,000. Okay. Now, market price per share, that has changed. That's not remaining the same. So, market price per share is rather over here. What will be the position of fund? This is not something which is different. We can definitely say that just the shares are getting increased, but we want to compute, let's say on the next day, the market price per share. So we'll take up these numbers: 20.3, 513.7, 513.7, then 290.8. We have 671.9.
Are we doing the C part?
Yeah. And then 44.2. Now you can get the value total over here, right? Now, revised NAV will be, of course, this value divided by the units. But we need to be careful about the units also, because if the HNI has given us 50 lakh rupees, we would have definitely issued some units to him. We would have definitely issued some units to him. So we'll have to compute the number of units issued. So number of units.
So we need to include cash also.
Sorry.
Cash also.
Yes, perfect. We also need to have the cash. The cash balance is already known to us, which is 2,40,800. Now, number of units issued to HNI, we can say it's going to be 50, because HNI gave us what, 50 lakh, and each of our units, 50 lakh, was divided by NAV as on that date when the HNI gave us check was 119.0475. 50 lakh divided by 119.0475. Okay. Now, give me the number of units less. What is the number of units issued to HNI? 50 lakh divided by 119.0475. Number of units which is issued to HNI.
42,000.
Exact 42,000.
0.042.
So let's keep it 42,000 only. Now the revised NAV will be completed by simply taking the number of units to be what? 8 lakh, original 8 lakh plus 42,000, right? And then give me this total value of all investments. Hmm.
10 crore 27 lakh
10 crore 27 lakhs
57,200.
37,200. Okay, 87 or 87?
7.
87,200. Okay, so the revised NAV will be 10 crore 27 lakh 87,200. 10 crore 27 lakh 87,200 divided by 8 lakh 42,000, which is 122.07. Right? That's the NAV. That's the revised NAV. Did we get it? Did you get it, everyone? Yeah. Okay. So that's this particular question that we were talking of. Now, let's take up another question. Okay, let's take up this question number 12 first. Okay, Mr. Y has invested in 3 mutual funds as per the following details. You have got mutual fund X, Y, and Z. Amount of investment is given 2 lakh, 4 lakh, 2 lakh. Net asset value at the time of purchase was 10.3, 10.10, and 10. Dividend received up to 31st March is 6,000, 0, and 5,000. NAV as on 31st March 2018 is also given to us. And they have given the effective yield per annum on 31/3/2018 which is obviously then percentage term. So it is 9.66%, 11.66% negative, and 24.15%. So 1 year is equal to 365 days. Mr. Y has misplaced the documents of his investment, and we are supposed to be helping him finding the date of his original investment after looking into each of these aspects. Okay. Now, what's the number of units in each scheme? So let's say we have mutual fund X, Y, and Z. We have to know what's the number of units that we have got in each of the scheme. The number of units in each scheme, how do we compute it? So for that, we have the amount of investment. Right. So investment is going to be like 2 lakh, 4 lakh, 2 lakh. Two lakh, 4 lakh, and 2 lakh. This investment is definitely going to be considered when we compute number of units. Number of units is going to be like NAV on purchase. So NAV on purchase is 10.3, 10.1, and 10. So what will be the number of units? That's going to be 2 lakh divided by 10.3, 4 lakh divided by 10.1, and 2 lakh divided by 10. Divided by 10.3, that's number of units.
1417.47.
1,400.
417.
19,470.
0.47. 0.48.
And 48. In the second case, that's going to be 4 lakh divided by 10.1, which is 39,603.96. Then we have 2 lakh divided by 10.
20,000.
20,000. Okay, that's the number of units. Then total NAV, total yield, and the number of days investment held. Now, total NAV, we don't know what's the total NAV. Which, when we're talking of total NAV, we're talking of the ending NAV. Now, NAV, dividend received up to 31st March is there. 31st March 2018 and 31st March 2018 NAV is given over here. So we can definitely say what's the total NAV. Okay. So total NAV, let's try to compute. Total NAV is, this is like NAV on 31st March 2018. So on 31st March 2018, NAV is going to be 10.25, 10, and 10.2. So total NAV on 31st March 2018.
1,99,000
1,99,000
and 29.17. 029.17.
029.17. Then in the second case, it's going to be 3,96,000. And then in the third case, it's going to be 20,000 into 10.2.
2,04,000.
That's going to be 2,04,000. This is the total NAV. Then we get the amount of total yield.
7,99,000.
Total yield is going to be
7,99,068.
total NAV minus NAV on purchase. or just write a formula over here. Total NAV, total yield is total NAV minus investment plus dividend upon investment. This is going to be like 1,99,029.17 plus a dividend of 6,000. And then minus 2 lakh, the whole divided by 2 lakh. Yeah. How much is this? How much is the percentage?
Two point five one four 5145.
2.5145%. Same way, calculate for Y. So calculation for Y will be, there's no dividend in Y. So it is simply 3,96,039.6 minus 4 lakh, the whole divided by 4 lakh.
Minus 11.
Minus 11%.
No, minus 0.9901.
Yes, sir. Minus 0.99.
Minus 4 lakh divided by 4 lakh. Minus 0.99%. Okay. What about the mutual fund Z? Mutual fund Z.
4.5.
So it's like 2 lakh is the investment and 5,000 is the dividend. So 2 lakh 4,000 plus 5,000 dividend minus 2 lakh investment.
4.5%.
4.5%.
Yes, sir.
Yeah. Okay. Then their question has given us that they've earned some effective return over here as on this date. So we need to compute the number of days and also then going backward and then calculating the day on which investment was made. So we need to first compute the number of days. So for that, the number of days, we have the NAV, we have the total yield and the annual yield given over here. So we can definitely get the number of days for which the investment was made. First, let us write down annual yield. Annual yield is 9.66%. Then 11 point minus 11.66%. Then we have 24.15%. I need to get the number of days. Now, how do I get this number of days? Like 2.5145 is a return for some portion of the year. We want to know the annual yield. How do I calculate the annual yield? Yeah, number of days, how are we going to get it? It's pretty simple. Number of days will be 2.5145 divided by 9.66% into 365, because we want to know out of 9.66%, 2.5145% is earned in how many days? So we can definitely get the number of days. How much is this number of days, guys? 2.5145% divided by 9.66 into 365.
95 days.
95 days. Perfect. So 95 days. What about the second case? The second mutual fund. What's the number of days?
31 days.
31 days.
30.99, 31 days.
Okay, 31 days. Then the last one.
68 days.
68 days.
68.
Got the number of days. Now we need to know the time period or the date on which investment was made. Right? So date of investment. How will I calculate the date of investment? Because these returns were calculated as on 31st March. So date of investment will be like 31st March. What is 31st March 2018? 2018 minus the number of days. So 31st March. Just take 31st March. Just take the 95 days subtracted from 31st March. Subtract 95 days from 31st March. So from 31st March, subtract 95 days. What is the date of investment?
27/12/17.
So it's like 31st March. So 31 days gone from March. Another 28 days will go from February.
90 days for the 3 months and then 5 days for.
So by the since it's 95 days, so we need to subtract like 5 days from the month of December. The 26th December will be the answer.
26th of December.
Right. Then the other case, it's going to be 28th of Feb, right? And then the third case, 58 days need to be subtracted. First March. So 31 plus 28, that's like 59. And another 9 days to be subtracted from Jan. So another 9 days from January, going to be 22nd January. Right?
So if we take 5 days, then 31, 30, 29, 28, 27, it will come 27th December.
No. After 27, you have only 4 days.
So we'll include 27 also, no?
No, you have made if you're counting.
So we do backward counting. Like we fix 31, 30, 29, 28, and 27. These are the 5 days.
28 to here you have 31 days, right? Correct?
Yes, sir.
Then as on 31st of 1, 58 days.
Yes, sir.
Then on 31st of December, 1 day.
90 days.
So this total cumulatively comes out to be 90.
Now 5 days are left.
So subtract 5 days from this.
So we'll say 31, 30, 29, 28, and 27.
So exclude 30 to 27 also, right? Because if you are taking 26th, then only you are having a gap of 5 days over here. Because after 26th, 5 days, then another 31 days, then another 28, then another 31.
Okay.
Right? Okay. So that's it. That's the solution for this question. Simple. Now, yeah, let's take up this question number 13 now. Yes. Mr. X on 1/7/2007, during the initial offer of some mutual fund, invested in 10,000 units, having face value of rupees 10 for each unit. Okay. Then on 31st March 2008, the dividend paid by mutual fund was 10%, and Mr. X found that his annualized yield was 153.33%. So Mr. X on 1/7/2007, during the initial offer of some mutual fund, invested 10,000 units having a face value of rupees 10. Then we have like on 31st March 2008, dividend paid by mutual fund was 10%. And then Mr. X found that his initial yield was 153.33%. Now let me just put this data in the form of a table. Date, transaction, amount, and then units. So on 1/7/2007, so on 1st July 2007, on 1st July 2007, you have a transaction as initial investment. You purchase 10,000 units. We don't know the amount of, obviously, the investment will be 1 lakh because it's the initial investment that you're making. Then on 31st March 2008, the mutual fund paid a dividend. Dividend paid by mutual fund was at the rate of 10%. Right? So if it's at the rate of 10%, we will be definitely knowing that 10% is going to be of investment of one of the face value. So this is like 10,000 units into 10 face value into 10%, which is amounting to 10,000 rupees. Right? Mr. X found that his annualized return, as on this date, the annualized return is 153.33%. Then on 31st March 2009,
Sir, how come that 10,000 dividend will come? It's invested on July 2007, not for whole year.
Invested for July. So what? That doesn't matter. Dividend, you get it for the full year, full term. Dividend, this is not a percentage per annum. This is a percentage of face value.
Okay, sir.
Okay. So as on that date, we have a return of 153. Then again, on 31st March 2009, dividend is paid at the rate of 20%. Right? Now, since the dividend is paid on paid at 20%, we don't know the amount, neither we know the units, but yes, the return, we don't know the return over here also, because they're just saying that 20% dividend was given. On 31st March 2010, Mr. X redeemed all his balance, 11,296 units. When his annualized return on 31st March 2010, the redemption is being undertaken. Right? So redemption is being undertaken of 11,296.11 units. right? And then your annualized return was 73.52%. Right? So the mutual fund has paid two dividends, and there we have the units and the return given to us, right? So we don't know the amount of redemption because since we don't know the NAV as on that date, the annualized yield is given as 73.52. The annualized yield is given as 73.52%. We want to know the amount of redemption, and rather we want to know what is the NAV as on each of these dates. Right? So that's how we want to compute it. So just think about it. I'll give you a minute's time. Just think about how are we going to approach this question, then I'll start with the solution.
Sir, first we can compute the NAV for 1st July 2007 using the unit and amount. Then we can find the
10 only because that's the initial offer. So that will be 10 on 1st July.
yeah. Then the first we can find out for 2028 that March 31st. Then we can go about 2009. Then finally we can find for 2010.
What do you think? The dividends over here, are the dividends paid to you in the form of cash, or how are they going to be dealt with? Are the mutual funds, I mean, the dividends are being given to you in the form of cash?
So reinvestment is not mentioned over here. We can assume it is cash.
You can assume it as cash. Pay attention to the number of units. Initially, you had 10,000 units. At the end, you're having 11,296.11 units. So what does that mean?
Yeah, unit is increased, then it's reinvested, sir.
It's reinvested, right? So since the number of units is increasing, it has definitely being reinvested, right? So every time we are counting on dividend, we need to check that the dividend is dividend is going to be something which is given to us not in the form of cash but by way of additional units, right? So I would just like you guys to think about it and work on this for maybe another next 5 minutes, and then I'll start with the solution. Try to solve this by taking into account, since we already know that the units will be reinvested. I mean, the dividend will be reinvested and additional units will be allotted to you. And the units that will be allotted to you will be at the respective NAV. Okay. Just try to solve this, guys. Just give me a moment, Sam. Okay, so are we able to get through it? I mean, how do we go about solving it? So we'll have to go day wise day. I mean, as per the date given to us. So let's talk of as on 31st March 2008. Okay. So as on 31st March 2008, we know the amount of dividend, right? So the amount of dividend is 10,000. Now, they're saying that the rate of return as on this date, which is the annualized rate of return, right? Is the annualized rate of return is 153.33%. So the annualized rate of return is 153.33%. We would like to definitely know what is the NAV as on that date, right? What is the NAV as on that date? If we are pretty sure about the rate of return, so since the rate of return is 153.33% annualized rate, so I can definitely get the value of investment or NAV as on the closing date. So we'll say let NAV on 31st of March 2008 be rupees X, right? This was 10,000, and we can definitely say that this rupees 1 per unit. So let's say the NAV as on this date is 8 rupee. Sorry, let the NAV be rupees X. Right. So if you're taking the NAV to be rupees X, then value of investment on 31st March 2008 will be 10,000 X. Right. So value of investment as on 31st March 2008 will be 10,000 X. Okay. Because we had 10,000 units, so value of investment will be 10,000 X. Then the amount of dividend, we know it is rupees 10,000. So we can calculate the annualized rate of return. The annualized rate of return to be simply value in time 1 minus value in time 0 plus dividend upon value in time 0. So value in time 1 will be 10,000 X minus value in time 0 is 1 lakh plus dividend of rupees 10,000 upon value in time 0, which is 1 lakh. Okay, then you just multiply this because we need to make it an annualized figure, right? So since it was 1/7/2007 and it's 31st of March 2008, we can multiply it with divided by multiply by 12, and we divide it by like from 1st July till 31st of March. So from 1st July till 31st of March, we can definitely say that it's how many months? So it's like 5, 7, and 3, 7 and 6 and 3, so 9 months. So into 12 by 9. And we know that this annualized rate of return as on 31st March is 153.33%. Right? So definitely we can say this is into 12 by 9 into 100. So just solve this and give me the value of X, guys. Solve this equation and give me the value of X. Solve this and give me the value of X, guys. Yeah. Solve this equation and provide me the value of x.
$20.49.
Okay, guys. How much?
499.
20.5. Let's take it as 20.5, right? So this is the NAV as on that date. Now we can definitely get the number of units also here. Because we know that this NAV will be used to give the amount of units, I mean number of units. So number of units issued for dividend. What will be the amount of dividend? 10,000 divided by 20.5. Yeah. What will be the number of units?
487.80.
487.80. 80. Okay. So now total number of units, after dividend. What will be the total units after dividend?
10,487.80.
So it's like 10,000 plus 487.80, which is 10,487.80. 10,487.80. Okay. Now, after this, that's the task which we have done on 31st March 2008. Now we have to look for 31st March 2009. So as on 31st March 2009, what we have is again the dividend. So let's compute the And do we have the annualized return? No, no annualized return is given over there. No annualized return is given over here, but we know the amount of dividend. So amount of dividend dividend at 20%. So amount of dividend is going to be 20% of 10,487.8 into 10. Right? Because the dividend is generally paid on the face value. So how much is this amount of dividend is?
2975.60.
How much?
975.60.
20,975.60. Right? Amount of dividend is 20,975.60. Now we don't know what is the units that have been allotted. Neither do we have the information about the annualized yield. Right? But then it's pretty clear that whatever the units will be issued, that will be totally adding up to this part, right? So units issued as dividend will be the closing units were 11,296.11 minus the previous units which we had, which is 10,487.8. So what's the units that have been issued as dividend? Because we have the units of 11,000 units of 10,487 as on this date. Right? And after additional units issued, it becomes 11,296. So the difference is basically the units which are issued to you as dividend. So units issued as dividend is 11,296.11 minus 10,487.8.
808.31.
8
808.31.
0.31. Okay. This is the units which is issued as dividend. We have the amount of dividend also. So we can definitely get the NAV on 31st March 2009. So that's like amount of dividend is 20,975.6 divided by 808.31. Yeah. How much is this?
25.95.
25.95.
95.
Right. That's 25.95. NAV as on 31st March 2009 is 25.95. Okay. Now, once this is done, 31st March 2009, it's 25.95, which is the NAV as on 31st March. That's 25.95. Do we need to compute the return? No, we're not going to. We just need to compute the NAV. Because NAV is done by us as on 31st March 2009. Right. So that's 25.95. Then finally going to the last date, which is 31st of March 2010. So NAV as on 31st of March 2010. Mr. Y redeemed all his balance 11,290 when his annualized yield was 73.52. So now, as on this date, the question has given us that annualized yield is 73.52%. Annualized yield is 73.52%. Okay. Now this annualized yield would be computed by obviously certain amount of NAV, annualized yield is 73.52%. So we would like to compute, we would like to know the NAV as on that date. And of course, there's no dividend or anything is paid out. So let's say NAV on 31st of March 2010 be rupees Y. So if this is rupees Y, we can compute the annualized yield to be the number of units, which is 11,296.11 Y minus 11,296.11 Y minus the initial investment, which was 1 lakh upon 1 lakh into 100 into what will be the number of months that will be considered, because we have started from 1st of July 2007. So 7, 8, we have like 9 months over here. Here we have 12. So 9, 12, 12, and 12. So 12 plus 12, 24, 24 plus 9, 33 months. So this is the return for 33 months. So we'll say into 12 by 33. And this is going to be equal to 73.52%. Yeah. So just solve it and get the value of Y, which will be the NAV as on that date. Calculate the NAV as on that date, guys. Get the value of Y. Mm. What's the value of y, guys? What's the value of y? 33.39, is it? Or let me just solve it maybe. 11,296.11 y minus 1 lakh upon 1 lakh is equal to 73.52 into 33 by 12 into 1 upon 100. So 73.52 into 33 by 12 divided by 100. This is 2.0218. Right, and that's 11,296.11 y minus 1 lakh upon 1 lakh. So that 1 lakh gets multiplied over here, which is 202,180, right? 202,180, and this is 11,296.11 y minus 1 lakh. So we have 11,296.11 y is equal to 1 lakh going on that side. You have 1,02,180.
No, sir, it is 3,02,180.
Oh, sorry, yeah. You get added.
Yeah, sir. Ha, sir.
302,180 divided by 11.29. 11,290.
26.75.
Yeah, so y value is 26.75.
26.75. I have understood.
Yes, this is the answer. 26.75. Got it, guys? Okay, did we get these numbers? Okay. Did we get this, everyone? Okay, fine, guys. So, with that, let's just take a break right now. Right, so we've done like good questions on mutual fund. So after the break, we will recap the concepts of corporate valuation. Also, maybe do 1 or 2 questions. Okay. So let's just take a break right now. Break of around 10-15 minutes, guys. Okay. Take a break, guys. See you soon. Yes.
Yes, sir.
Okay, so let's go for the next topic, which is business valuation. Again, a conceptual topic with good number of practical examples and questions for that. So let's simply go to the initial concepts, and then we'll do maybe one or two questions based on this. So we are aware that value of a business entity, or value of any security for that case, which is going to grow at a particular rate, let's say growth rate, that's going to be computed as cash flow in year one upon K minus G, right? Because this is a Gordon formula where we are assuming that cash flow is going to grow at a constant rate, right? So, but then if we have a situation where the growth rate is not constant, but growth rate is like, it's going to be higher for initial years and then settling down to a lower value at later years. So, for example, let's say growth rate is 10% for 4 years and 5% from year 5 onwards. So, growth rate being 10%, your cash flow for the first year is 10. Then, okay, so 10 growing by 10%, another 10%, another 10%. So it's going to grow at 10% for 4 years. And then in the 5th year, right, from 5th year onwards, since the growth rate is coming out to be now 5%, right? So we can definitely get the terminal value as terminal value equal to value in year 4, which is cash flow in year 5 upon K minus G. Right, so cash flow in year 5 upon K minus G, that is the value which will get the value of the business in year 4. Right, so in year 4, we are going to get cash flow in year 5 upon K minus G. So cash flow in year 5 is going to be 13.9755. Right, so you get the cash flow 5th year, and then you get the value in year 4. So what we have to essentially do is present value of all cash flows from year 1 to 4, and then also taking the present value of the terminal value. This is a two-stage dividend discount model also. This is a cash flow based approach. Another approach is going for an asset based approach, wherein we compute the net asset value, which is the book value of the business. We are simply adding up all the assets and then subtracting the liabilities. Net realizable value will be the realizable value of assets minus the realizable value of liabilities, right? Replaceable value, the cost of group of assets and liabilities of equivalent company in the open market. So replaceable value is basically the cost of group of assets, all the assets and liabilities. If you are going to replace them at a current market price, then what will be the value you are going to fetch? Income-based approach, what we use is based on P ratio, because if you have the EPS computed, if you have the P, comparable P from the other companies, you can definitely get the price as EPS into P. Capitalization of earnings will be simply taking the annual future maintainable profit, you divide it by the required return. Annual future maintainable profit upon required return, that's the capitalization of the earnings. Now, cash flow based approach, we have to compute something called as free cash flow approach. Now, free cash flow, we can first get the profit after tax number. We start with profit after tax. We subtract one-time income and one-time expenses, which are non-recurring income and non-recurring expense. Right, so non-recurring income, non-recurring expense are going to be adjusted. We add back the depreciation to make it a like, a cash flow item, because we would have subtracted depreciation when computing fact. So we write down the free cash flows. Now this free cash will be growing at a particular rate. Also, we need to adjust the working capital. Like if there is an increase in working capital, you're going to increase your investment. So there's going to be a cash outflow. You're going to subtract it. Similarly, any planned capital expenditure needs to be subtracted. You get the adjusted free cash flow. You multiply it by the PV factor. to get the PV and then also take the present value of the terminal value. In total, that's going to give you the cash flow. That's going to give you the value of the business. Okay. One important aspect is understanding the beta. Risk of the equity shareholders is what going to be measured as an equity beta, whereas the risk of the business is going to be measured as asset beta. And we have already seen that equity beta will be asset beta into debt plus equity upon equity, or you can say asset beta into debt into 1 minus t plus equity, the whole divided by equity. Right? So that's your equity beta. So asset beta is going to be computed as asset beta will be the risk of the business, and risk of company will differ from one entity to another entity. Risk of business and risk of equity shareholders will differ from one entity to another entity. So beta of unlisted company. So how do we get the beta of unlisted company, right? Suppose if a company is not yet listed, it's a startup. So how are we going to get the beta of that company? So for that, we need to take a look at similar companies in the market which are into the same line of business. So we take the equity beta of that company, and then to that equity beta, we apply this formula, right? And we get the asset beta of the listed company. Now this asset beta is denoting the business risk of the listed company, and then that asset beta, right, is going to be further converted to equity beta of the unlisted company based on debt equity structure of the unlisted company. So this asset beta which we are using for us, for our company valuation, that will be called as a replica or a proxy beta. Okay. So just need to remember this equity beta and asset beta connection, wherein we say equity beta is asset beta multiplied by debt, post-tax debt value plus equity upon equity. Okay. Yeah. So that is
Can we have the formula, sir, for this?
for what?
How to convert beta of unlisted company?
Yeah, it's
That,
the same formula. Like you take equity beta of listed company, right? So you get it over here. Right? This value is there. Now, substituting the debt and equity value of that listed company, you will get the asset beta. Now, this is the asset beta of the listed company. Correct?
yes, sir.
And now, since both the companies are into the same line of business, the asset beta is going to be same as the asset beta of the listed company should be ideally same as the asset beta of the unlisted company, right? Because both of them are into the same line of business.
Okay, sir.
Then that replica of unlisted company is going to be used to calculate the equity beta of the unlisted company. Okay.
Okay, thank you, sir.
Okay. Now let's get started with once again. There is some concept left out over here. Let me just do that first. Then we will do that. Yeah. Yeah, we have this economic value added concept. See, the concept or the idea over here is when we're talking of a business entity, the primary motive of a finance manager of a business entity is to enhance the wealth of the investors. Right? It is to enhance the wealth of the investors. Now, wealth of the investors can be enhanced only by providing them with a rate of return which is as per their expectation. Right? Or maybe the returns exceeding their expectation, right? So, under such situation, we can say that the investor would be definitely requiring some sort of return. So, let's say the capital invested is 1,000, and on that, the rate of return expected by investor is 12%. So, expected or required return in INR by investor of the company is 1,000 into 12%, which is 120. But we would like to know what is the return that company has actually generated, right? So, actual return which the company has generated is given to be NOPAT, which is net operating profit after tax. Right? So actual return generated in INR by the investor is net operating profit after tax, which is stated to be EBIT into 1 minus T. Right? So that's EBIT into 1 minus T. EBIT is 200. 200 into 1 minus 0.3, let's say 140. So has the company exceeded the expectation of the investors? Has the company exceeded the expected return of the investors? Yes, because investors are expecting 120. Investors are expecting 120, whereas the actual return which is generated is 140. So there is an additional return which is generated to the tune of 20, and this 20 is what we call as economic value added. This is what we call as the economic value added. Right? So simply speaking, economic value added is computed as EBIT into 1 minus T minus the invested capital into WACC. Minus the invested capital into WACC. Okay, that's your economic value added. So that was the concept which we had. Apart from that, yeah, some EV EBITDA multiple is there. So enterprise value and EBITDA multiple, again, it's a multiple based approach. So EBITDA is basically earnings before interest, tax, depreciation, and amortization. Enterprise value is what? Is the market value of equity plus the market value of the debt. Right? So enterprise value is the market value of equity plus market value of the debt. So we have like, let's say, we have 3 companies that we observe in the market with their profit after tax available, interest, tax, depreciation, suppose everything is added, and we also have the EBITDA numbers for the 3 companies, right? And then we also have the market price per share, the number of equity shares, which will give us the market value of equity and also the market value of debt. Then we get the enterprise value. Okay, so this first company is having an EBITDA of 225 for an enterprise value of 1600. Second company is having an EBITDA of 260 for a EV enterprise value of 1460. The third company is having an EBITDA of 170 for an enterprise value of 980. So EV EBITDA multiple, when we say EV to EBITDA multiple, 1600 by 225, then this is 1460 divided by 260, and then we have 980 divided by 170. So EV EBITDA multiple, we get it as 7.11, 5.61, and 5.76. So these are the multiples that are applicable. So we'll say in this industry, what's the average multiple that's there? So we get the average EV EBITDA multiple, average of all 3 of them. Right? Now, if we have a company D, which is having an EBITDA of 35, then the value of D, let's say this is 35, the value of the company is going to be simply multiplication of this average multiple with the EBITDA numbers. Okay, so that's the EV EBITDA multiple way of obtaining the value of the company. Then there are certain ESG aspect and all is given. So there's another method, let's say chop shop method. So this is a chop shop method which is used to value the conglomerates. Conglomerates, when you say that one business entity is not having any impact on the other business entity. So let's say if you're into multiple businesses, there's no synergy effect amongst the businesses. All businesses are definitely of different valuation and different area altogether. So if you have three or more or many multiple businesses and you want to value the entire company, then you need to value each of the businesses separately. Okay, sorry guys. So here we have 3 different business entities. So each of them is going to be valued separately, right? And then you add up together, right? That's your chop shop method. So if you have, let's say, online food delivery, instant goods delivery, and cab services, there are 3 different divisions of your business. You've got their assets, you've got their sales value, you've got their income. and you look at similar business entities multiple, say sales multiple, asset multiple, income multiple, and then you apply these multiples to get the value. You take the value of each of the businesses based on different dimensions, take the average of it, and then you simply take the total value of the company together. Right? So that's your chop shop method that we generally use. Okay. Now, let's just go for valuation of distressed companies. So distressed companies are the companies which are defaulted or are likely to default on their debts. Right. So distressed companies are the companies which have defaulted or are likely to default on their debts. Now, the reason why DCF cannot be used for these companies, these distressed companies, they don't have any sort of stable or perpetual or those cash flows which can be forecasted. So the assumption of perpetual cash flows is not valid as the negative cash flows in these businesses. Discounted cash flow may yield negative value as there are negative cash flows from the businesses. Right? So discounted cash flow are likely to yield negative value. High discounting rate may be used which may further lower the value. So what we do is we calculate a modified way of DCF. Now, how do we get this modified? So in modification, we are not looking at a fixed value of cash flow. Rather, what we are really looking at is cash flow which is based on probability, right? So you'll have a list of probability in which you will say that when the company liquidates, what is the likely value of the company? When the company liquidates, what is the likely value of the company? So that is like, what's the cash flow that you can expect in different scenarios? So you calculate the expected cash flow. Right? Expected cash flow will be the probability into cash flow multiplication, or you can also say that it's simply cash flow into 1 minus probability of distress. Then value of equity can be obtained as discounted cash flow value of equity into 1 minus probability of distress plus distress value of equity into probability of distress. So for example, if there is no default by the company, wherein we say that the chance is 40%, right? If there is no default by the company, then we are likely to get 230 as a valuation, right? And then 230 as a valuation. Then we have, when there is a default, we say that 60% probability that the value is going to be 12. So if the company default, then the realizable value is going to be 12. So probability into value will be 40% into value and 60% into value. So you get the value of the company to be 99.2. Then adjusted present value is similar to the Modigliani-Miller model, which we have learned in CA, which is Modigliani-Miller model, wherein we stated that adjusted present value or adjusted value, it's going to be like unlevered firm value plus tax benefit, right? Tax benefit of the debt, which is value of levered will be equal to value of unlevered plus debt into tax. So same concept over here. But one more thing additional that we do over here is we subtract the expected bankruptcy cost from the debt. Okay. Now, expected bankruptcy cost is simply the unlevered firm value minus the distress sale value, this entire thing multiplied by the probability of distress. Right? You can also undertake relative valuation, wherein we say regular company, the enterprise EBITDA value is maybe 2x. In case of distressed company, we can definitely say that it is 1.25x. Right? Okay. All right, guys, fine. Okay. Now let's just start with the certain questions based on this. Yeah, let's try this question number 1. I'll do it in pen paper mode only. Let's take up this first question. Okay. ABC company is considering acquisition of XYZ, which has got 1.5 crore shares outstanding and issued. The market price per share is 400 at present. ABC's average cost of capital is 12%. Available information with XYZ indicates that its expected cash flow for next 3 years are as follows: 250, 300, and 400. Calculate the range of valuation that ABC has to consider, and then we have got the PV factors also. Okay, so we're simply going to take the present value. So you'll say year, cash flow, PV factor, and then PV. So year 1, 2, 3. Cash flows are 250, 300, 400. PV factors are 0.893, 0.797, and 0.712. We just need to take the present value. Can you give me what's the present value of this? Get the present value is
223.25.
2.
Total.
Total. What is the total?
Sir, 747.15.
747.15. Right, this is the present value of all cash flows. And market price per share, like this is 747.15 crores. So what should be the value of one share? Value of one share will be 747.15 crores divided by the number of shares outstanding is 1.5. So 747.15 divided by 1.5. What's the value of one share?
498.1.
498.1. Market price of each share is given to be 400. So obviously, what is the range of value that we are looking to obtain? What is the range of values that we are looking to obtain? Yeah.
400 to 498.
Yes, 400 to 498. Correct. Okay, so it's going to be from 400 to 498. That should be the range of values. Easy? Fine. Now, let us consider let's try out this question number 6. Valuation of Hansel Limited has been done by an investment analyst based on an expected free cash flow of 54 lakhs for the following year and an expected growth rate of 9%. The analyst has estimated the value of Hansel Limited to be 1800 lakhs. So we have a free cash flow of year 1 to be 54 lakhs, growth rate with 9%. So value is coming out to be 1800 lakhs. However, he has committed a mistake of using book value of debt and equity. This guy has used the book value of debt and equity, right? So when you say that he has committed a mistake of using book value, what we are supposed to be knowing is the book value and the market value, but they're saying the book value weights employed by the analysts are not known, right? But you know that Hansel Limited has a cost of equity 20% and post-tax cost of debt is 10%. So cost of equity is 20% and cost of debt is 10%. Value of equity is thrice its book value, whereas the market value of its debt is 9/10 of its book value. What is the correct value of Hansel Limited? Right, so we want to revise this particular valuation because this valuation is arrived on the basis of book value, right? So weighted average cost of capital has been taking the book values. We have the cost of equity 20% and cost of debt is 10%. Right? So we would first like to know what are the weightage of equity and debt under book value, and then we will revise it for the weightage as per the market values. Right? So first we need to get what is the value of overall cost of capital, right? And then we need to look at the weightages, and then weightages will be revised, and then the new value will be obtained. So we would definitely know that V0 value in year 0 would have been calculated as free cash flow in year 1 upon overall cost of capital minus growth rate, because we are taking free cash flow, we are not taking dividends. So value is 1800, which is 1800 is equal to 54 upon KO is something which we don't know, minus growth rate is 0.09. So first, give me the value of this KO, guys. What's the value of overall cost of capital over here? What's the value of overall cost of capital? Yeah,
12%.
12%. Okay. Now this 12% would have been computed as KO equal to weight of equity into cost of equity plus weight of debt into cost of debt. So overall cost of capital is 12% equal to weight of equity into cost of equity is 20%. We can definitely say weight of debt is 1 minus weight of equity into 10%. So can you just solve it and give me the value of weight of equity, and of course weight of debt can also be obtained similarly. Solve it and get the weight of equity, guys. What's the value of K, guys? Not sorry, K. What is the value of weight of equity? Sorry, guys. Value of weight of equity. What's the weight of equity, guys? 0.2. Okay, let me solve it if you're not able to get it.
20%, sir.
20%, okay. So this
I
is
don't know whether it is correct or not.
okay. 20 weight of equity plus 10 minus 10 into weight of equity. So 12 minus 10 equal to 10 weight of equity. So weight of equity will be 2 by 10, which is 0.2. So weight of equity is 0.2. Weight of debt will be 1 minus 0.2, which is 0.8. But we need to remember that these weightages are the book value weightages. Now, weight of equity, we have to get using market value. Market value based weights. Now, we know that value of market value of equity is thrice its book value, whereas market value of debt is 9/10 of its book value. So we'll say market value. So if we say if book value of equity is 20, then we'll say book value of debt will be 80. So what will be revised book value of equity? Sorry, revised not book value, but market value of equity will be book value of equity multiplied by book value of equity multiplied by well, the book value of equity is thrice its book value. So this is into 3. So which is 20 into 3, which is 60. Market value of debt will be book value of debt into 0.9. which is 80 into 0.9, which is 70. Okay, so 60 and 72. Now we can get weight of equity, which is market value based. That will be 60 upon 72 plus 60. And same way we will get weight of debt, which is based on market value, is equal to 72 upon 72 plus 60. So what's the weight of equity? What's the weight of equity? 60 upon 72 plus 60. Um, 60 divided by 132, which is 0.4545. And weight of debt will be 0.5455. We have got the weightage of equity, weightage of debt. We can now definitely get the KO, which will be 0.4545 into overall cost of equity is 20%. This into 20% plus 0.5455 into cost of debt is 10%. So what's the overall cost of capital value?
14.55.
14.55. Okay. So that's 14.55% KO. Now after KO 14.55%, we can get the value of the firm now based on market value. Free cash flow is 54 upon 0.1455 minus growth rate is 0.09. What's the value of the firm?
$974.7.
974.7 is the value of the firm. Okay. Let's try to take up this question number 8. Following information is given in respect of WXY Limited, which is expected to grow at a rate of 20% per annum for next 3 years, after which the growth rate will stabilize at 8%, 8% per annum normal level in perpetuity. So this is going to grow at 20%, after which the long-term growth rate is 8%. For the year ended 31st March 2014, you have a revenue of 7,500 crores. Cost of goods sold is 3,000 crores. Operating expense is 2,250. Capital expenditure is 750. Depreciation is 600. Now, during high growth period, revenues and earnings before interest and tax is going to grow at 20% per annum. Right? So during high growth period, revenue and earnings is going to grow at 20% per annum, and capital expenditure net of depreciation will grow at 15% per annum. From year 4 onwards, that is a normal growth period. Revenue and EBIT is going to grow at 8% only. Incremental capital expenditure will be offset by depreciation. During both high growth and normal growth rate, net working capital requirement will be 25% of the revenue. They have been given us the weighted average cost of capital. We are required to estimate or calculate the corporate income tax. Income tax rate is 30%. You have to value using free cash flow for the firm and weighted average cost of capital method. Okay, so first our task is to compute the free cash flow for the firm, and after that we can definitely go for the weighted average and then the present value aspect. Okay. Yeah, so first we need to calculate the revenue. Then going ahead with high growth rate is going to be for next 3 years. So we need to obtain the free cash flow for 4 years. Okay, so we have like year 1, year 2, year 3, and year 4. Because 4th year is the terminal year, so we need to consider the 4th year also. I'll just give you the model. Maybe we'll have to write down the revenue. We'll have to subtract the COGS and the operating expense and the depreciation. So less COGS, less operating expense, less depreciation. This will give you EBIT, right? And then we'll make it as a post-tax figure, which is profit after tax. So we're going to subtract the tax, right, because we are anyways calculating the FCFF. So since we're calculating FCFF, we are not going to subtract interest. So less tax will give us profit after tax or earnings after tax. From that, we are supposed to subtract the capital expenditure and also working capital investment. When you do that, you finally get the free cash flow for the firm. Okay, so just take down this format based on the data given in the question. Try to fill up these values and get the FCFF values. I'll just give you maybe around 5 minutes for this task. You can take this format and then I'll place the question in front of you. So format is simple: revenue minus all your expenses, EBIT. Then you have less tax, PAT, and this is going to be obviously the capex is net capex. This is net of depreciation impact. Right? So depreciation which you have subtracted over here, when you take net of depre, that depre automatically gets added over here. Right? So this capex is net of depreciation capex. Yeah. So get these FCFF values for 4 years, guys. Yeah. Placing the question and the format for FCFF in front of you. Get this FCFF values, guys. Get the FCFF values for all the 4 years. Okay, let me start with this. So year one, revenue is going to be like this is as on 31st March 2014. This is going to grow at 20%, right? So revenue is going to grow at 20%, and then capital expenditure net of depreciation will grow at 15%. So revenue in first year, since it was 7,500, so 20% hike in that will make it 7,500 into 1.2, which will make it as 9,000. And then on 9,000, we have another 20% hike, so 10,800. Around 10,800, another 20% hike, so you'll get it as 20,960. And in year 4, 12,960 into 1.2. 12,960 into 1.2. No, not 1.2, because from year 4 onwards, the growth rate is going to be 8%. Right? So growth rate is 8%. So on 12,960, you have 8% growth rate. So that's 13,996. 13,996.8. You subtract the COGS from that. So COGS is going to be given as a percentage. It's 3,000. So even the
So these will also increase.
Sorry.
So these cost of goods sold will also increase.
Yes, as the revenue increases, it's also going to increase by 20%. In fact, operating expense is also going to increase by 20%. So we have the COGS, like 3,000 being the base year. So year 1, it will be 3,600. Year 2, again, it's going to increase by another 20%. So that will be 4,320. Then on 4,320, you add another 20%, 5,184, and then 8% to that, which will give us 5,598.72. That's your COGS. Operating expense, it is 2,250. But in this operating expense, definitely the depreciation portion is also going to be there, because depreciation, which is included in operating expenses, 600, right? So as the capital expenditure is also increasing. Now they're saying that during high growth, EBIT is going to increase by 20% and capital expenditure is going to increase by 15%. So in the year 1, 2, and 3, we can definitely say that the operating expense of 2250, out of that 600 is the depreciation. So it will be like 2250 minus 600, this into 1.2 raised to number of years, right? So when we do that, in the first year, the operating expense will be 1980. To that, again, you add 20%. So that will be 2376. third year again you add 20%, that is 2851.2, and then year 4 it's going to be 3079.3, taking 3% as 8% as a growth rate. Then depreciation, initially it was 600, but that's also going to increase by 20%, because the question says EBIT is going to change by 20% every year. So there will be 864, 1036.8, and then 1119.74. Okay, then you have the EBIT, which is 2700. In year 2, the EBIT is going to be 3240. In the third year, the EBIT works out to be 3888, and then fourth year it's 4199.04. So you subtract the tax at the rate of 30%, right? And then you get the profit after tax, right? So subtract the tax at 30%, and then you get the tax figure. Okay, so 2700. On that, we are going to subtract 30% tax. So we're left with PAT of
810.
Yeah, 810, 1890. And then the second year,
972. Tax.
972 is the tax. Right? Okay, then this is 2268, 1166.4, 2721.6. Then this is 29. Sorry. Here the tax is going to be 1259.71. And then the PAT is 2939.33. Okay, so that's your profit after tax. Now, once you've got the profit after tax, now coming to the capital expenditure. Capital expenditure over here, it is 750 crores. It's 750 crore in the first year. So, of course, this net capex, which is 750 minus the depreciation was of 600. Right? So, 750 minus 600. So 150 was the value. On that 150, there is going to be a growth of 15%. So 150 into 1.15.
172.5.
172.5, yes. This is what? 172.5. Then next year it is again growing by 15%, 198.38. Then 228.13, and then from year 4 onwards, both of them are going to offset each other. Working capital investment needs to be subtracted further to arrive at the final FCFF figure. So working capital figure is going to be arrived simply by this working note. Let's say this is working capital investment. So you have year 0, year 1, year 2, year 3, and year 4. You have the sales. And regarding working capital, they're saying that the working capital will be 25% of the revenue. Working capital will be 25% of the revenue. So working capital will be 25%. Then we'll say, what's the incremental working capital? Incremental working capital. So sales, we know it is 7,500. Then we have 9,000, 10,800, 12,960, and 13,996. Right, so working capital at 25%, 7,500 into 25%. 1875. into 25%, that's 2250. 10,800 into 25%, which is 2,700. 12,960 into 25%, which is 3,240. 13,996.8 into 25%, that's 3,499.2. So incremental working capital here, it will be 375, then it's 450, then this is 540, and then it is 259.2. So let's write down this working capital expenditure figures, which is 375, 450, 540, 259.2. Okay, you can get the FCFF value now. The FCFF value, this will be 1342.50. Then the other will be, second year FCFF will be 1619.63. Second year FCFF, then third year FCFF will be 1953.47. Last year FCFF is going to be 2680.1. Okay, now we have got the FCFF. One important other number that we need is terminal value. We need the terminal value. Terminal value is basically value in year 3. Value in year 3 will be FCFF of year 4 upon KO minus G. FCFF of year 4 upon KO minus G. FCFF of year 4 will be 2680.13 divided by KO is the overall cost of capital is given as 15%. So that's like 0.15 minus growth rate of 0.08. Okay, so what is this number? 2680.13 divided by 0.07. divided by 0.07, which is 38,287.57. So now we have to take the present value of all cash flows. So you have year cash flows, PV factor at 15%, and then PV. So year 1, 2, 3. When in third year, so year 1 is 1342.5. Second is 1619.63. Third is 1953.47. And then again third year 38,287.57. Right, so write down the PV factors given in the question, and then 0.8696. 0.8696, then we have 0.7561.
0.6575.
Yes, 0.6575. Yeah. So just calculate it, take the total, that will be the business value. Okay. Identify what's the business value.
Oh, 28,850.52.
28,850.5. Okay. 28,850.52. That's the answer. everyone. Yeah, so that's how we get the value of business using the FCFF model. We've also seen the EV/EBITDA example. We are anyways know in the security valuation the dividend discount model, which is the Gordon model given to us. Okay. Now, apart from this, we have the questions predominantly from also the enterprise value. Economic value added. Just quickly solve this question 10. RST's current financial year income statement is reported a net income after tax as 25 lakh. The net income after tax, which is PAT, is 25 lakh and applicable corporate income tax rate is 30%. Following is the capital structure of RST at the end of the current financial year. So you have the capital structure over here. Following data is given, equity beta is given, risk rate is given, average market risk premium is given, risk premium, so which is basically RM minus RF. We have to first get the weighted average cost of capital. Right, so we would get the weighted average cost of capital. Yeah, so first we get the cost of equity as per CAPM as RF plus beta into RM minus RF. So RF is 8.5 plus 1.36 into 9%, which is 20.74. Cost of debt, it's given to be 11%. Coupon rate is 11%, but this is a before tax number. So we want to make it as an after tax number. So after tax will be simply 11% into 1 minus 0.3, which is 7.7%. Weighted average cost of capital will be computed as weight of equity into cost of equity plus weight of debt into cost of debt. Right, so 20.74 and 7.7% is used. But the weightage that we are going to use is 40 out of 165 for the weightage of debt and 125 out of 165 for weightage of equity. Right, and then you get the weighted average cost of capital. We already have the PAT, so we need to get the NOPAT, which is net operating profit after tax. That can be computed as EBIT into 1 minus T. So to PAT, I just make it first a profit before tax number and then add back interest, which will give us a EBIT. Net operating profit after tax is EBIT into 1 minus T, which is 4 lakh 11,429 into 1 minus T, which is 1 minus 3, 1 minus 0.3. That will be your net operating profit after tax, 28 lakh 8,000. Then we have weighted average cost of capital into total capital employed as 17.58% into 16 lakh or 1 crore 65 lakh. That will be 29 lakh 700. So NOPAT is this and weighted average cost of capital is this. Enterprise value added is simply the difference between that, which we are observing it as negative. Right, so we have a negative EVA over here. So EVA can be computed on these typical lines. Okay. So with this, we have done like quite a good number of and variety of questions to revise the concepts. If you have got any queries as of now, you are free to ask. Any queries, guys, you can ask. In case there are no queries, then we can definitely call it a day.
Thank you, sir. Thank you.
Okay.
Thank you, sir.
Thank you. If you have any queries, you can definitely email us to this particular email ID, or you can also make a call to this landline number. Okay. Fine. Then with that, let's just stop here for the day, guys. All the best for your exams.
Thank you, sir.
Yes.
Manoj?
Sir.
Okay. Now, your class is over?
Yes.
So, okay. Now, student, thank you very much for attending the session. And Jagbandhu sir has shared our telephone number as well as the email ID. If you have any query, you are free to ask at this number. So, Jagbandhu ji, with this, I think we have covered the part of business valuation.
Yes. Business valuation.
Mutual fund and valuation.
Mutual fund.
So, student, with this, we have overall completed our revision of 12 chapters. Okay, now the only 13 chapters have been 3 chapters have been left. Okay, so now we have covered I think 13 chapters we have covered and 2 chapters have been left. So we shall cover in the forthcoming class. Okay, that will held our day after tomorrow. So, student, thank you very much for making this session interactive, and thank you, the Jagbandu sir, sparing your precious time and enlightening the student. Okay, student, revise whatever had discussed in today's class, and if you have a query, you are free to ask it. Thank you, Jagbandu sir,
Thank
and
you.
thank you, student.
Thank you, sir.
Thank you. Thank you, Beta. Thank you. Thank you.
Thank you, sir.
Thank you. Thank you. You're welcome. 2 minutes.